Hello and welcome to a discussion on valuing inventory at lower of cost or market and how errors valuing inventory impacts the financial statements. After viewing this video, you'll be able to compute lower of cost or market using the three methods of individual item, groups, and in total. You will be able to adjust inventory to market when market is less than cost and determine the impact of inventory errors on cost of goods sold and income. Inventory is initially valued at cost using FIFO, LIFO, or average cost. Then, lower of cost or market is applied to make sure that inventory is reported at an amount that does not exceed probable future economic benefit. If the cost of inventory is higher than the fair market value, the inventory must be reduced to fair market value. This process of comparing cost to fair market value is referred to as the lower of cost or market method. Inventory is reported on the balance sheet at the lower of cost or fair market value, which is the expected future benefit. This method is used to ensure the value for inventory reported on the balance sheet is not higher than expected future benefit. Reducing an asset is an expense. The amount of the reduction from cost to a lower fair market value is reported as cost of goods sold on the income statement. No adjustment is ever made to increase inventory when fair market value is higher than the original cost of inventory. Inventory may not be reported at higher than original cost. Any gain in value will be reported in the period the inventory is sold for more than cost. Fair market value may decrease when new products are introduced to the market, a lower price competitor enters the market, or when seasons change. These circumstances can result in a lower sales price than the original cost. Generally accepted accounting principles define market for lower of cost or market as the inventory's current replacement cost, except that market cannot be higher than net realizable value or be lower than the net realizable value less a normal profit margin. The ceiling prevents inventory from being valued higher than what is expected to be realized from the sale. The floor prevents the company from reducing inventory too much in the current period and recording a loss in the current period and a higher than normal gross profit in future periods when inventory is sold. Let's walk through an example of how to practically apply lower of cost or market. Take a moment to review the information related to each of the company's products. Replacement cost and net realizable value are estimated amounts made by the accountant working with purchasing and sales managers. Lower of cost or market can be determined by individual groups, groups of products, or in total for the company. We will first compute lower of cost or market based on individual products. To perform lower of cost or market, set up the table with the three columns related to market. A column for cost and a column for the lower of the cost or market amount. Let's look at product A first. Replacement cost and net realizable value are given. The floor is the net realizable value less 20% of cost, which is normal profit. The middle value is the market that meets the can't be higher than and can't be lower than rule. This is then compared to the cost of 1,000. At this point, only the market and the cost are considered, and the lower of the two is placed in the lower of cost or market column. This is repeated for product B, and the middle number of the first three columns becomes market, which is compared to the cost, and the lowest, which is cost, is put in the LCM column. Repeat this procedure for all products. Total only the cost and the LCM column. An adjustment is made to reduce inventory if LCM is lower than cost. This is done only using the totals of the cost and the LCM columns. In this situation, historical cost is higher than LCM, and inventory must be reduced to the LCM amount or the amount of probable future economic benefit. The key to this approach by individual products is that each product has its own LCM and the adjustment is made based on the total LCM compared to total cost. The second way LCM can be implemented is by groups of similar products. The first step is to group the products and total the 3 market columns for the group. The middle market number for the group becomes the market. Total the cost for the group and compare the total cost to total market for the group to determine the lowest of either cost or market. For the first group, cost of $2,600 is lower than the market of $3,080, and lower of cost or market is the lowest of $2,600. Notice that only the totals for the group are used to determine lower of cost or market. Repeat the process for the next group. After all groups are finished, total the cost and the lower of cost or market column. Inventory must be stated at the lower of cost or market, and since cost is higher, inventory is reduced by lower of cost or market for the difference. Let's recap. Start on the left. First, for each group, select the middle of the 3 on the left to be market. Use the group totals only and compare to cost to determine LCM. Do this for all the groups and then total only the cost and lower of cost or market columns for each group. If LCM is lower than the cost, reduce inventory to LCM. The last way to determine LCM uses only total amounts for each column. Total each of the 3 market columns first. Determine market as the middle value using the total amount only and put that amount in the market column. Then total the cost column and compare. The lowest of either market or cost goes to the LCM column. Cost is then compared to LCM. In this situation, cost is lower than market already and no adjustment to inventory is required. An error made in determining the value of inventory also results in an error in the amount reported on the income statement for cost of goods sold. The 2 accounts, inventory and cost of goods sold, equal the total amount of goods available to sell to customers. An incorrect count of inventory or an error in computing the cost of inventory at the end of the period will also result in an error in the value of cost of goods sold reported on the income statement. Errors are generally caused by an incorrect count of quantity in the warehouse or errors computing the cost of inventory at the end of the period. Cost of goods sold is computed as inventory available to sale less the value of inventory remaining at the end of the period. In this example, ending inventory is correctly valued at $50. If inventory is incorrectly valued at $150, $100 higher, cost of goods sold is $100 lower and gross profit and income is $100 higher. When ending inventory is not correct, beginning inventory for the next period and cost of goods sold for the next period is also not correct. The higher ending inventory becomes higher beginning inventory and higher goods available, which leads to a higher cost of goods sold and lower gross profit and income. After viewing this video, you should be able to compute lower of cost or market using the 3 methods of individual item, by groups, or in total, and adjust inventory to market when market is less than cost. You should also be able to determine the impact of inventory errors on cost of goods sold and income. Please log on to studymyaccounting.com and work through practices you learned for examples of how to do the computations discussed in this video. Then work the practice test. Please write out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is very much appreciated.